Chatterjee, MD and CEO of the company. Let's go across and listen into what the outlook was. What more did they have to say?
We had called out that there was, higher than expected furloughs in the last quarter, which had an impact in terms of, how the quarter performed in Q4, where we had a sequential decline. And apart from that, there were a couple of specific projects in the BFSI, which where we went through cancellations because clients reprioritized their spends. But the good news is that we pretty much closed the full year, with a record order intake. It's 5.6 billion, which is almost 15.7% up from the last year. So which is very good news. And this market conditions were difficult. We were shifting from typical discretionary spend to a longer term efficiency play. So that shift that has happened very well. We have a very balanced portfolio right now, and which also positions us very well in terms of attacking the discretionary spend as and when it opens up.
Let's hope and see when that discretionary spend does open up. But you talked about a couple of cancellations that happened. Help us understand a bit more about it in terms of what was the reason of cancellation, and do you see any other deal perhaps which is at the risk or something that you're watching out closely, or maybe the billings and the ramp ups have been a bit slower? And also any indication you want to give us for Q1 then?
No, I think this is a very specific issue pertaining to two new projects that we had started. This is totally unexpected, and these are resulting from the decisions the clients have taken in terms of reprioritizing their spends. I don't think we need to think of this recurring again. And this had an impact of 80 basis points for this particular quarter. And beyond that, we don't comment on any client-specific issues.
No, fair enough. I understand that. But from Q1 onwards, do you see a bit of a rebound in growth? And for BFSI, would you call this the bottom? Because it's been declining for what, 4 quarters now?
No, I think, if you look at the overall picture for the full year, you will see that every industry vertical that we cater to has grown on a full year basis. Now, there could be some decline in 1 quarter or 2 quarters, but we also look at the overall full year basis. So from a full year basis perspective, BFSI is grown 2+%. And I think that is a good sign. And we definitely feel that there'll be a rebound as we go along. And not only BFSI, but I think as we look at Q1, we definitely feel that we'll be back on the growth trajectory, and it will be a broad base. It's just not BFSI.
Okay, waiting and watching for that broad-based growth. But you talked about a full year. So let me ask you about the full year question for FY25. When we started off FY24, we were all hopeful of a double-digit growth at least for LTIMindtree. Ended the year at around 4.5%. What do you think FY25 would be like? Do you anticipate it to be at least better than FY24 with a high degree of conviction? You can say that?
Well, I think it's, if I look at the overall market scenario, the macro, the geopolitical, etc., I don't think there is anything which is significantly different than what has been in the last several quarters. So it's very early days to call it out. But I always believe that the growth that we talk about is a reflection of the portfolio of clients that we have, for the accounts that we manage. So from that perspective, I think, as we said, definitely Q1 will be a growth, and it's difficult to call out about the full year, but the ability to execute is definitely going to be better. So our execution plan that we have put together will be definitely much more robust in FY25.
Okay, let's talk about that execution plan a bit more, because in terms of the margins also, DC, I wanted your insights on that, because if I look at the subcontractor expenses, they are pretty much close to the bottom. The utilization is quite high. What then would be the margin lever going forward, and when do you reach that 17 to 18% band? Do you anticipate it to be the exit rate at least for FY25?
Well, I think when you talk about margin cannot happen unless you get the revenues. And that is precisely the reason why we changed our margin plans in last quarter, where we said that we still have the overall aspiration to get to the band 17 to 18% band, but we are not going to make any promise to get it in a specific time frame. But what I want to assure you is that margin is not a one quarter phenomenon. Margin is a discipline, and that discipline has to be executed, quarter after quarter. So there is a very robust margin plan, or rather margin program, that we have within the organization, which gives me the confidence that over the next quarters, we will definitely see some improvement in the margin. And at the right time, we should be able to tell you in terms of, once we do the replan in terms of when we want to get to the band. But I don't think I want to focus on the margin at the cost of growth. And once the growth comes back, the margin also will come back easily.
DC, the street has been a bit worried about the attrition at the senior level. That was something we were worried about at the merger time. Didn't really happen then, but now a couple of years out, it's playing out. What's your sense on the attrition? What are you doing to stem that attrition?
Well, I think, during the merger time also, we had a bit of a churn, which was expected. But if I just look at the overall last 1 year since the merger has been, let's take the last 4 quarters where the merger is pretty much behind us. What you see in terms of attrition is BAU. I mean, that attrition happens everywhere. And the confidence that we have is because we had the access to 2 leadership teams, 2 mid-managements. So we are able to cope with that fairly well. I mean, that is not really reflecting in terms of our results, and we are not really concerned about that. I mean, it's not good to have attrition, but we have a plan in terms of managing through that. And I don't think we should be attributing that to anything other than BAU.
Okay, business as usual, the kind of churn that we have seen. And before I let you go, DC, a word on the order pipeline and the deal momentum as well. For a lot of other companies, it's been very strong with respect to deal momentum. You, of course, have also had a record year in terms of deal wins. But in terms of the pipeline, in terms of the decision-making from clients, is that on expected pace?
Well, I think the decision-making is still a little cautious and a little delayed. But the good news is that what we disclose is the order intake or the order book, which is gone up almost 16% year over year. But there is a very healthy pipeline as well, so which gives us the confidence that as we close more and more deals, the order book will only increase as we go along. So decision making is still a bit slow. The clients are still a bit cautious. But at the same time, there is a lot of deal activity going on. And we are hopeful that that will fructify in terms of growth as we go along.
If you like this video, then like, share and subscribe to ET Now.